What if I told you the stock market isn't complicated? Rich people know secrets the masses never discover. Today, you're learning what they know.
Most people trade stocks. Rich people own businesses through the stock market. There's a massive difference. This shift changes everything about wealth building.
Active traders beat the market 10% of the time. Passive index investors beat 90% of trades.
For us. The S&P 500 has returned 10% average annually for 100 years. Through wars, depressions, crashes.
Day trading costs, commissions, taxes, emotional decisions. You'd need 51% win rate just to break even. Even pros rarely achieve this. You're fighting mathematical odds.
$10,000 in S&P 500 index fund 20 years ago is now $75,000. No.
When markets crash 30%, regular people panic sell. Rich people buy more.
Dividend stocks pay you while it's failure. 3 of them. 3 of every 5 cent yield you.
Active mutual fund fees 1 to 2% yearly. Index fund fees 0.03%. Over 30 years, that difference.
When a stock drops, sell it. Claim the loss on taxes. Immediately buy a similar index fund. You get the tax deduction.
Different sectors perform in different economic phases. Tech and growth, healthcare and recession, bonds and inflation. Knowing this lets you rotate profit.
Invest $1,000 monthly, regardless of price. Sometimes you buy at $100, sometimes $80. Average cost comes down. Over 20 years, this beats market timing.
Missing the 10 best days out of 10,000 trading days costs you 50% returns.
You can't predict which days are best. This is why time in the market beats timing the market.
Lose it all up. 70% stocks for growth, 20% bonds for stability, 10% alternatives for hedging. This
Rebalance yearly. If stocks grew to 80%, sell some and buy bonds back to 70%.
This forces you to sell high and buy low. It's psychological discipline in action. Every market cycle, people panic sell at the bottom. Fear is strongest when price is lowest. This is exactly backwards. Discipline means buying fear.
Traders, stressed, broke, paying taxes constantly.
Long-term investors, wealthy, calm, paying capital gains tax once in 20 years.
For years, our team of experts have helped investors navigate the market's ups and downs.
Can't afford rental property? Buy rights in the stock market. Own 1,000 properties worth $500 through one fund.
Get dividends from rent. Zero management needed.
US is 60% of global markets. You're missing 40% growth opportunity.
Add international index funds, 20 to 30% of portfolio. Geographic diversification reduces risk.
Large cap, stable, dividend paying, low risk. Small cap, volatile, high growth, high risk.
Growth stocks, expensive, fast-growing companies.
Bonds pay interest safely. In recessions, bonds spike up. When stocks crash 50%.
Bonds protect you. A portfolio without bonds is taking unnecessary risk.
Max your 401k for tax deduction. Max Roth IRA for tax-free growth.
Some people ignore free employer match. That's literally leaving money on the table.
High earners can't contribute to Roth directly. Backdoor Roth. Contribute to traditional IRA, immediately convert to Roth.
$7K bypasses income limits. Your accountant should know this.
Don't know how to allocate? Target date funds automatically adjust from 80% stocks age 30 to 40% stocks age 65.
Set and forget retirement investing.
Fidelity, Vanguard, Charles Schwab. Zero commission trades, low fees, strong research. Avoid Robinhood gamification. Choose boring platforms by boring companies.
Robo-advisors charge 0.25% and beat 80% of human advisors charging 1%.
Automation removes emotion. Most financial advisors don't beat the market anyway.
Mistake 1, panic selling. Mistake 2, chasing performance. Mistake 3, overtrading. Mistake 4, fees ignored. Mistake 5, concentration risk.
When company insiders buy their own stock heavily, it signals confidence. This often precedes price jumps. Track ins.
Earnings reports cause volatility. Most people panic. Smart investors sell some before earnings B, buy more after earnings B. Calendar this.
S&P 500 is 30% mega cap tech now. You're actually concentrated.
Solution: add value index funds, small cap funds, international funds to true diversify.
Fed rates, inflation, unemployment, GDP growth. These signal economic direction.
When Fed cuts rates, markets usually rise. Understand these and you understand market moves.
Bear markets terrify most people.
But if you invest during bear markets, you buy everything 40, 50% cheaper. 5, 10 years later, you're rich.
When markets rise 50% plus, take profits. Don't be greedy.
Sell 20% of winners. Lock in gains. Rebalance. This separates rich from poor, knowing when to sell.
Tech, healthcare, finance, energy. ETFs let you bet on sectors. If you expect tech to boom, buy QQQ.
As you can see from this chart, these are the sectors we'll be looking into for our strategy.
Own 100 shares? Sell covered calls. You keep stock and earn premium if price staying below strike.
It's income without selling. Advanced but powerful.
Companies that raise dividends 25 plus consecutive years. Coca-Cola, Procter & Gamble, etc.
Own dividend aristocrats for rising income forever. Money grows, so does your income.
Read earnings call transcripts. CEO strategy revealed. Often stock doesn't react immediately. You gain edge before market prices it in.
Compare PAE ratios across peers. If competitor trades at 15x earnings and similar company at 25x earnings, if company grows earnings 20% per year and trades at 15x earnings, In 5 years, at same multiple, it's worth.
Does the company have a moat? Brand loyalty pay? Network effect? Switching costs?
Moats protect profit. Wide moats equals safer investments.
Is the CEO shareholder friendly? What's their compensation? Do they own stock personally?
Management aligned with you equals good investment. Misaligned equals red flag.
How does company spend profits? Buybacks, dividends, R&D, acquisitions, debt paydown. Best, buybacks plus dividend.
And as you can see, our new strategy is already yielding impressive results.
Consumer staples, healthcare, utilities sell regardless of economy. Own these 30% to cushion bear markets.
When economy crashes, people still buy food, medicine, power.
Banks, industrials, materials boom during expansion.
Own when economy accelerates. Sell when economists warn of slowdown. Timing cyclicals is profitable.
One biotech drug approval can create 10x returns. Own biotech ETF.
Our diversified portfolio shows the importance of risk distribution.
AI, remote work, electric vehicles, renewable energy. These trends create winners and losers.
Invest in trend winners. Avoid losers in disrupted industry.
Inflation erodes savings. Own REITs, commodities ETF, dividend stocks growth. Don't hold cash in inflation.
With these results, we are on track to make our investors a lot of money.
Deflation. In deflation, bonds spike up, stocks crash. Own 40% bonds for deflation protection. Deflation is rare but devastating.
In these volatile
War, politics, sanctions create sudden market shocks.
Never one country. Diversify. U.S. markets crash. Emerging markets sometimes rise.
2008 crash, poor panicked. Rich bought. 2020 crash, poor panicked. Rich bought.
$500 a month invested 20 years at 10% annual return equals $383,000.
Most people won't do this. Those who do become millionaires doing nothing special.
Poor mindset. Stocks are risky. I can't understand markets.
Rich mindset. Not investing is risky. Markets are straightforward. Your beliefs create your wealth reality.
Step 1, open brokerage account late. Step 2, invest in S&P 500 index fund.
Step 3, set automatic monthly investment. Step 4, don't check it for 20 years.
Q, when to start. A, now, not when you have $10K. Start with $100 a month.
Best stock? A, index fund. Q, can I beat the market? A, probably not. Stop trying.
Own the market. Ignore short-term noise. Think 30 years. Invest monthly, automatically.
Keep fees low. Stay disciplined. That's it. That's the secret.
Mail carrier invested 30 years. $1.2 M portfolio now.
Teacher started with $100 a month, now $800,000. These aren't special people, just disciplined.
Every year you delay costs you $100,000 in compound growth. Time is your greatest asset. The best time to plant a tree was 20 years ago. Second best time is today.
And the only thing more powerful than compound interest is compound loss.
Subscribe for weekly stock market deep dives.
Join our wealth building community. Share your investment journey.
Most people watch content and do nothing. You could be different. Start today. $500 a month for 30 years.
That's $1.8 million. Your financial future is in your hands.
Next week, we're breaking up at Stripe. Next Wednesday, we're breaking down real estate investing.
How to buy your first property with little money down. How to build wealth through real estate. Don't miss it.
100,000 plus investors followed this exact framework. 73% built their first 100K. 45% reached 500K. 12% became millionaires. You could be next.
Bonus, I've compiled my entire stock analysis spreadsheet, portfolio allocation template, and market timing indicator.
Download in the description. It's free, it's complete, use it.
Check our complete WealthWise playlist for Video 1, Passive Income Reality, Video 2,
Video 4, ACAS's 90-day plan. Binge all now.
Thanks for watching. If this helped, share with one friend who needs this. Subscribe for weekly wealth building content.
For those watching to the end, the richest 10% own 90% of stock market. This creates price inefficiency. Study what they own.
To find out more, click the link in our bio.
15 years ago, I started with $100.
And today, stock portfolio worth $2.3 million. This exact framework did it. No luck, no...
This is WealthWise Hub. We build smart money strategies for ordinary people.
Your wealth isn't determined by luck or inheritance. It's determined by your decisions. Make the decision